So gold is a low volatility asset that provides three portfolio attributes over the long run. One is actually capital appreciation. So many in the insurance industry, many investors generally, you don't have to be in the insurance industry, will say, well, I'm interested in gold. It's in the headlines a lot, but really, Akash, it doesn't pay a dividend. It doesn't have a yield. But gold does provide capital appreciation over the long run. Not that history is any guide for future financial performance, but it's important to note that since 1971 and the Nixon shock and the US exiting the Bretton Woods system in the free floating US dollar era, gold has had average annual returns over the last 5.5 decades of around 7 to 8%, and frankly, closer to 8%. Real returns adjusted for inflation have been 3 to 4%. So gold is a low volatility asset, less volatile than equities, providing better returns than cash plus inflation. That's point number one, capital appreciation over the long run provided in your portfolio. Two, it does so as a low volatility asset that's traditionally very low correlation to stocks and bonds. Certainly over the long run, if you look at static correlations, it tends to provide diversification benefits and very low correlation to traditional stock and bond portfolios. So that's a positive because by adding gold to your 60/40 or 70/30 construct, and again, that might not be the insurance industry, but just broadly speaking, what you're essentially doing is improving what's known as your Sharpe ratio or your volatility adjusted return over a long horizon. And this is particularly true during liquidity events and drawdowns, where bonds, yes, they were the traditional safe haven and hedge. But what we discussed earlier, Stuart, is that since 2022, bonds have not been the traditional safe haven hedge that they once were, given positive US stock bond correlations and given the fact that this fiscal and inflation impulse that's keeping the back end or long end of rates sticky is just changing that dynamic following a 40-year bull run for the bond market from the early 1980s up until the pandemic shock. And then the last point is that gold really does serve as an alternative fiat hedge as part of this story of global debasement and concerns that there will be some sort of tail event, whether it's a geopolitical or geoeconomic shock, that could require restructuring in developed markets, something we see more often in emerging markets. So I think you put all of those three things together, but gold has a unique role in the portfolio in that construct.